Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 16th of January. So the markets remain on the front foot following the weaker than expected inflation data from the US this week. We had PPI and CPI come in weaker than expected. Today the focus was on retail sales and jobless claims. Well, retail sales came in slightly weaker and that kept the bullish momentum intact, at least for now anyway. The S&P 500 chart here shows a falling wedge pattern, which is a bullish continuation pattern. The idea is that once the resistance trend of the wedge breaks, that the market continues in the prevailing trend, which has been bullish obviously. Still, following a sharp rally, we could see some profit taking, especially as bond yields remain elevated, bouncing back slightly following yesterday's big drop. Key support levels to watch include 5916, this level right here, which was the high from last Friday when the US jobs report caused the markets to drop quite sharply. Well, that level is now broken, so once resistance, it could turn into support. Below that, we have this area here at around 5880, which has been support and resistance in the past. But essentially, the election gap has been filled and the markets have bounced right where they needed to. So the trend is clearly bullish, and for the bears to come back, we'll need to see a clear reversal pattern once again. Now in the fixed space, you can see that the yen is the strongest currency pair. It's up against all the major currencies, including the pound, the New Zealand dollar, and so on. The euro yen is one I'm watching very closely because it's testing the 160 level, which is a key support. But with the Japanese bond yields continuing to rise, we could see a potential downside breakdown from here. So a daily close below 160 could potentially pave the way for a drop towards 158, which is where the support trend comes in to play. Below that, we don't have anything significant until the August 2024 low at 154.40. Will it get all the way to those levels? Remain to be seen, but we do need to get a daily close below the 160 level to potentially trigger that move down. In terms of resistance levels to watch, well, the level I'm watching is at 160.78, the low from the previous day. That level needs to hold if the bearish momentum is to continue. The dollar yen itself has not broken down completely yet. It has found some resistance from the shaded area where previously it had dropped back in the summer of last year. It did test this level back in November and then we got a reaction, but that level has now broken. We went above it for a while, but as you can see in recent trade, we have moved back below. So the dollar yen is a bit volatile, but because of the ongoing strength in the US dollar, we're not seeing too much of the yen strength in this currency pair. That's why I favor looking at a yen cross instead as speculation rises about a potential rate hike from the Bank of Japan next week. For more insights, make sure to check out the news and analysis section at cityindex.com. See you in the next video. Take care.